Hey everyone, welcome to episode 69 of the Julia La Roche Show. I am pleased to bring to you this conversation with Joseph Wang. He is the CIO of Monetary Macro and the author of the blog fedguy.com, as well as the author of the book Central Banking 101. By the way, I read a copy of it over the weekend and highly recommend that you pick up a copy. It is super informative. Joseph is also a former senior trader on the open markets desk at the Fed. In this episode, we do a deep dive into the inner workings of the monetary system. We also got his outlook on the US dollar, especially amid all of this talk around de-dollarization. We also got Joseph's macro view and why he thinks we are in the early stages of an inflationary cycle. So expect persistent inflation in the years ahead. We also got his take on the collapse of Silicon Valley Bank and why the banking crisis is behind us, and much, much more. I really enjoyed this conversation with Joseph, and I think you will too. And by the way, if you are new to the channel, welcome. It is so great to have you. Please be sure to hit that like button and that bell so you can subscribe and you won't miss any future episodes. This show is completely free, and your support will help me bring some more amazing guests for some long-form discussions. And if you're listening to the podcast, please be sure to leave a rating and a review so more folks can find the show. Again, thank you so much for your support. I couldn't do it without you. I appreciate it more than you know. And I hope you enjoy this episode with Joseph Wang. Joseph Wang, CIO of Monetary Macro, also a former senior trader on the open markets desk at the Fed and author of the book Central Banking 101. And also, I should note, the blogger at the Fed Guy, which is a blog on developments in financial markets. Joseph, it is so great to welcome you on this show. Thank you so much for joining me today.
Thanks so much for inviting me. It's a pleasure to be here.
Well, I mentioned your book, Central Banking 101, which I did the audiobook version over the weekend. And I gotta say, I'm like, wow, I wish I had this earlier in my career because it's such a great and informative read. So congratulations on that. And, you know, one of the things I learned from reading it is that you were pursuing your JD, you were in law school, and you ended up in a career in finance and also working for the Fed. So I was kind of hoping maybe, can we start a bit with your background and kind of how you got to where you are today, like your interest in pursuing this career path?
Yeah, sure. So I studied econ and math in college. And, when you're, let's say, 20 years old and you're looking for a career, oftentimes, if you're a young man, you're thinking about having, well, I want something that's fancy and I want something that makes a lot of money. So to my 20-year-old mind, I was going to law school, being a lawyer. After all, they look so fancy on TV and they have pretty high starting salaries. And so that's what I did. I went to law school at Columbia. I graduated and I did end up at a large law firm in downtown Manhattan. Great views, very fancy office, good salary and all that. But there's just one downside they never prepare you for. And that's you actually have to practice law, and that's just not a lot of fun. So, I mean, practicing law, it's very different from day to day than it is from what you see on TV. You rarely ever go to the courtroom. A lot of times it's just paperwork. So you're basically writing term reports for the rest of your life. And so remember sitting in my office, it's like 8, 9 o'clock, just going through a 200-page contract, looking for extra commas, making sure everything makes sense. And I couldn't imagine spending the rest of my life doing something so boring. I graduated in 2008, and at that time, what everyone was thinking about, what everyone was talking about was the financial crises. I saw, the Dow Jones go up and down tremendous amounts of volatility, people freaking out, a lot of people losing their jobs, and the Fed doing all this interesting stuff called quantitative easing that I had never heard about. So that seems so exciting and interesting to me, just understanding how the world works, understanding how it all fits together. It wasn't, it was really hard for looking at chasing commas to compete with that. So I decided that I wanted to do something in the financial markets for my career. But that was really difficult because I was a lawyer and it was 2000, right after the financial crises. There are no jobs available. So I sent resumes everywhere. I was reaching out for alumni and they're like, you should be happy you have a job. Can you get me a job? So that was a difficult way to transition. And eventually what I ended up doing was I ended up going back to school. So I did I did a master's in financial economics at Oxford, and then afterwards I became a credit analyst for a couple years. The credit analyst was interesting. So I focused on securitized products. So again, from my perspective, it was trying to get away from law into something that's more markets based, and credit analysis farther from law, not quite where I wanted to be. Ultimately, I found my way on the open markets desk, which is the Fed's trading desk. So the Fed actually has a sizable trading desk in New York, and that's the desk that they use to conduct all their open market operations. So when the Fed is doing quantitative easing, when it's doing emergency lending to commercial banks or to foreign central banks, it's done through the open markets desk. So I ended up there, just applied, did a bunch of interviews, and they chose me, and I thought it was a really good experience because when you're on the open markets desk at the Fed, you're basically in one of the centers of the global financial system. The Fed obviously is one of the major actors, and when you're on the open markets desk, everyone talks to you. We had relationships with all the big banks, all the big investment funds, money funds, everyone who participates in the market. They're willing to talk to the Fed in a candid way. So when you talk to a whole bunch of people, you can get a sense of what's going on in the markets, an inside look that is really impossible elsewhere. So you can develop a good sense of just how the market works, how things function. And to add on to that, the Fed also has tremendous amounts of confidential data. And so based on that experience, I was there for 5 years. I learned a tremendous amount. I wrote a book about it, Central Banking 101, as you mentioned. Uh, Honestly, it's surprisingly a bestseller on Amazon. I mean, because I self-published, and now among other things, I teach and write about the markets from my experience.
I love that. And you do a really nice job in the book kind of explaining the open markets desk and why it matters. And I didn't know like the amount of conversations that you would have on the desk and whatnot. And as you just mentioned, self-publishing this book, which I gotta say for the folks watching and listening, I read a lot of books on this show, and this is go get it, pick up a copy, and it's an easy read, and I mean that in a really complimentary way, meaning you can get through it in an afternoon, but it's like jam packed with a lot of incredible information. So thank you for writing it. But I was kind of hoping maybe I want to hear what was it that made you want to self-publish, and what were kind of the gaps that you were seeing in terms of just the inner workings of the Fed. And I guess a lot of people, I mean, I'm still learning. I don't know a lot. I'm still learning as I go and host this show. But I imagine there are a lot of knowledge gaps out there. What was it for you that you really wanted to fill or tackle?
Yeah, my sense was that people really misunderstood how the financial system works and how the monetary system works, and you can kind of see that in a couple ways. You can see that with how people covered quantitative easing right after the financial crisis, and you can also see how people covered commercial banks today after the Silicon Valley Bank panic. So, as a good example, during after the financial crises, the Fed did quantitative easing, and they did it to a sizable degree, and they'd never done that before. And at that time, there were all these people, basically doomers, saying that, my gosh, we're going to have hyperinflation, got to buy gold, buy guns, buy ammo. And we did see the price of gold continue to soar significantly. And at the end of the day, 10 years afterwards, I think we can safely say that they were completely wrong. And that's because they misunderstood how the financial system works. And that these nuts and bolts of how things actually work are not easy to learn unless you actually work at a central bank. And I would say that even in the academia, even if you stuff that you learn in textbooks, is not often clear and sometimes not very good. I remember back in 2009, you had many prominent people come and echo this line of imminent hyperinflation that never materialized. So there's just a lot in macro in particular. There's a lot of stuff that is, I guess it's not easy to learn, and what's in textbooks is not often accurate. And I think what they really all missed is simply just what money is in the financial system. So, for example, going back to quantitative easing, we saw the Fed printing a whole bunch of money. Everyone was worried, and that is exactly what they did. But what they failed to understand that money is a lot more than, let's say, deposits at the Fed or deposits at a commercial bank. in the financial system, treasury securities are also a form of money. If you think about it, I mean, $100 bill is $100 printed by the US government. How is that different from a $100 treasury bond, also printed by the US government, right? It's kind of like money that pays interest. So although the Fed printed a whole bunch of money, they used that money and they bought a whole bunch of treasuries. So it's kind of like printing a whole bunch of 20s and going out and buy a $100 bill. So you don't actually change the amount of money held by the private sector. You just change its composition with the side effect of lowering interest rates, which is exactly what happened. So, just having that understanding, would have saved a lot of people a lot of anguish, but it was hard to get unless you are actually from a central bank.
Why isn't that communicated more clearly?
Yeah, so my personal view is that there's a big disconnect in what is taught in textbooks and in economic courses in the academia and how the world actually works. And we all know that there's a disconnect between, school and real life. But I think the difference in macro is sizable. So I think there's a lot lost, of a lot lost in that process where what happens in real life is not filtering over to the professors and so forth.
Mhm. I think and I'm again I did the audiobook version, so a lot of this is just kind of like recall here. I thought one thing that was interesting, it wasn't just like printing the actual dollar bills. You also made a point, I guess it was like the commercial banks. Um
Yeah,
a lot of it was like, I guess, more digitized, like the reserves
yeah,
and
yeah,
whatnot. And then also you got into the Eurodollar market. Can you kind of help frame up kind of just
yeah. So
systematically
I
how it
think
works?
so. What people don't understand is that in the modern banking system, banks are creators of money. So if I go and ask a bank for a loan, I think the common misconception is that the bank actually takes money from someone else and then lends it to me. That's not how it works at all. The bank doesn't take money from one person and lend to another person. What a bank does is that it creates money out of thin air. So that's what makes banks so important and so highly regulated because they have the power to create money. Um, that power is highly regulated and it's subject to a whole bunch of constraints. Banks want to make loans that can be repaid. They want to make loans that have high enough interest rate that they will be profitable for a bank, and they have to be subject to all sorts of capital and liquidity ratios. But at the end of the day, they don't take money from one person to lend to another. They create money outright, and that's why the health of the banking sector is so key to economic growth. Banks get to decide who has money and who doesn't, and they make that decision based on whether or not the borrower will repay. So when you have a healthy banking system, able and willing to make loans, that means that good projects, good businesses get funding, the economy can grow, and that's good for the economy. But when the banking system is not healthy, which it was not after the great financial crises, even though interest rates are low, even though there are borrowers willing and able to repay loans, they don't get money because the bank is not healthy enough to lend. They are nursing their own losses.
Yeah.
Now, your comment on the Eurodollar market is one of the most exciting things of the US dollar system. What makes the US dollar system different from any other one else in the entire world is that dollars are used throughout the world, not just in the US. Now, it may sound strange for someone based in the US to say, I will go to a bank and say, I want to have a bank account and I want to put euros or Japanese yen or Chinese RMB inside, but that doesn't happen in the US. But if you are abroad and if you are a business person, it's very common to go and have a dollar deposit account. The reason is that dollars are used throughout the world. If you are a corporation in international trade, you're buying and selling in items that are invoiced in dollars. Even if you're a Japanese company or European company buying from someone in, let's say, India or Indonesia, oftentimes statistically, about half of the transactions are invoiced in dollars. So you need dollars to function. And so there are banks around the world that have dollar businesses. You can get a dollar loan in Japan, you can deposit dollars in France and so forth. And so that's really unique about the dollar system. It really also, I think, significantly um, extend the influence of the Federal Reserve, since the Federal Reserve controls interest rates for all US dollars, and that indirectly impacts financial conditions in developing countries. And that's also why we see a whole bunch of very important people start complaining when the Fed is hiking rates. I remember last year there was an article where President Xi Jinping of China was telling the Fed, please don't raise interest rates. A few years ago, we had at that time, the governor of the Bank of India also having an op-ed in the Financial Times complaining about the Fed doing quantitative tightening. So that's because of the dollar system.
I want to explore that a little bit further with you because, again, this is something. One of the reasons that I love hosting this show is I get to have really incredibly intelligent folks like yourself on to help all of us learn and get better. And I've had this conversation about the Eurodollar market with folks like Nick Bhatia. It came up with the Hugh Hendry episode, and we also did an episode recently with Jeff Snyder of Eurodollar University. And again, I'm still trying to wrap my mind around it. And I was hoping we could just understand the importance of it, because I think you touched upon it there nicely in this answer. And also, I noticed too in the book, and this is more like mental recall here, about how I think it was the Eurodollar futures contracts are such they're a way to understand like the economic fundamentals. So it's one of those indicators you could look at, like a really important one. I was hoping maybe we could just frame it up a bit more because, again, you're helping all of us learn and get better.
Sure. So I would separate the offshore dollar banking system, so the Eurodollar banking system, with the Eurodollar futures. So what the Eurodollar futures are is they are a bet of where interest rates will be, short-term interest rates will be in the future. And if you are a market participant, you use those Eurodollar futures for a couple things. One is to speculate at what the Fed would do, because when the Fed is raising interest rates, what they're doing is that they're lowering or raising the short-term interest rates. So if the Eurodollar futures or the short-term interest rate futures are, let's say, projecting a 5% federal funds rate, okay, a 5% short-term interest rate a year from now, then that suggests that the market is thinking that the Fed is going to hike rates to about 5% next year. So if you have a view on what the Fed is going to do in the future with their short-term interest rates, you would express that view by speculating in the Eurodollar markets. Now, there's just a small detail here. So the Eurodollar technically is tied to something called LIBOR. It's a common interest rate, but they're also changing that to something that's more based on SOFR, which is a new interest rate. But just that's all in the weeds. The point is that it's a way to speculate on short-term interest rates, which is what the Fed controls. Now, the other way that you would speculate in the Eurodollar futures would be if you wanted to hedge your portfolio. Now, let's say, for example, you have a big portfolio of bonds, corporate bonds, or something like that, that's not really liquid. And you're worried that when interest rates go higher, you're going to lose a lot of money on those corporate bonds. One way you can do to protect yourself is you can take offsetting positions in Eurodollar futures, and that allows you to gain if the interest. So you can position your portfolio such that when interest rates rise, you'll lose money on your bond portfolio, but you'll make money on the Eurodollar futures, and so you'll be even. So it's a market for speculation and for hedging, and people. It's a very deep and liquid market, so it's a good way to understand what the market is pricing in right now. So when I look at the Eurodollar futures today, April 17th, so it's pricing in a very different story than what the Fed is projecting. The Fed, through Fed speakers and their quarterly Fed dot plot, are telling the market that they want to keep interest rates around 5% for the rest of the year. But if you look at the short-term interest rate futures, the market is saying that the Fed is going to be cutting rates later in the year. So again, it's a very different story. So it's a good way to figure out, just what the market is pricing in.
Wait, I have a quick follow-on. Sorry to interrupt, but
Yeah.
is that like the market's fighting the Fed there, or like because if you listen to what they're
Yes,
saying,
yes, it is
okay,
absolutely the market's fighting the Fed. So everyone in the market knows, don't fight the Fed, right? But the market has been fighting the Fed nonstop for the past couple years, and the market has been very wrong. So the market has always been pricing in a lower terminal rate and also pricing in a Fed that's more inclined to cut. Fed has been basically bullying, well, the market has been bullying the Fed, but the Fed has been winning so far. My expectation is that the market continues to be wrong on this. So you mentioned about Eurodollar banking earlier.
And is that totally different from the Eurodollar futures
Yeah,
market?
it's
Okay.
different. The Eurodollar futures are about speculating on where short-term interest rates will be. But the Eurodollar banking, it's just basically a bank outside of the US that has dollar deposits and makes dollar loans. For example, let's say that you are a bank in France. You have a company that is an international company that needs some dollars. Then that French bank can make a dollar loan to this French company, and that would be there'd be an offshore dollar loan. It would be part of the offshore dollar system. And the offshore dollar system is pretty large. So it's about 30% the size of the onshore dollar system here. So the US banking system in the US about I think let's say 20, 22, 23, 24 trillion, something like that. Your dollar system is about a third of that. So that's a lot of dollar transactions happen outside the US, which is what makes the Fed special and what makes the dollar special.
Yeah. Okay, so I want to hear your thoughts because lately, and you probably know where I'm going to go with this, there have been a lot of headlines of late around de-dollarization. Some folks thinking like, maybe that reserve status of the US dollar, that's going to, I don't know I don't know how long that would take for that to go away, but I want to hear your thoughts around the narrative around the US dollar, de-dollarization, your thoughts there.
Yeah. So that's definitely going to happen in the future, but the future is really far away. Now, just for some context, now nothing is forever, right? We used to have a great Roman Empire, and we used to have, a great British Empire, and that's all not here anymore. It wasn't, and before the dollar was the world's reserve currency, the British pound was, and before that, we had other currencies. So the reserve currency is nothing that's forever, it's always changing. And in time, it will not be the US dollar either. That's just how history works. But I think right now that we're pretty far from that point in time. When you look at, let's say, any statistics or any data on the topic of reserve currency, it looks like the dollar is still very, very dominant. The Bank of International Settlements, which is the central bank for central bankers, collects a lot of data on global foreign exchange transactions. And they show that basically the dollar is basically overwhelming the currency that people trade overwhelmingly. Almost all currency trades are pair trades against the dollar. So I think maybe 80, 90% of foreign exchange has a dollar at one side of the trade. And if you look at global trade, still about half of all of international trade is invoiced in dollars. So, you want to move away from that, that's going to take some time. I think it's really difficult to move away from that for a couple reasons. First is that a currency is kind of like a payments network. So there's a very strong network effect there. For example, MasterCard or Visa. Everyone uses MasterCard or Visa because they're accepted everywhere. If you have a credit card, the most important thing to you is that you can actually use it. You have smaller networks like Discover that are pretty good networks as well, but most of the time you don't really want to have a Discover card because you can't use it as widely as you can MasterCard or Visa. It's the exact same thing for dollars. The US dollar has a very wide network. It's accepted everywhere in the world. So people like to hold dollars. The second thing that I think that's hard to just move away from is that the US dollar, well, there's not a lot of good alternatives. Not just about network effects, but if you want to be the reserve currency, you have to have a place where you can park your money. Let's say, for example, the Chinese RMB wants to be a world reserve currency. Okay, so that means that I'm going to deal in Chinese RMB, I'm going to borrow in Chinese RMB, and I'm going to accept a payment in Chinese RMB. But where am I going to park all my money? there's really no place to park it. Am I going to park it in the Chinese markets? Well, the markets aren't very deep, they're not very liquid. And there's this problem where if something happens, maybe the government doesn't like me and I'm not able to get my money out of the country. In order to be a reserve currency, you have to have a very deep place to park your money. In the US, that's treasuries or the US equity market or the US corporate bonds or agency MBS market. All these markets are very deep and liquid. That's just not true for anyone else. So until that changes, it's really hard for any other currency to be a reserve currency. No, I think it will happen. I think the US is doing a lot to encourage other people to not use the dollar. For example, one of the things they did most recently is to politicize the use of the dollar. When Russia invaded Ukraine, the US and Europe basically froze the foreign reserves of the Russian central bank. Now, that means that, well, if you are a foreign country and you're looking at this, you're thinking that, well, that means that if the US doesn't like me, they can take away my dollars. That's political risk there. And that encourages people to diversify their assets to use other currencies. So the US is working hard to try to push people to out of the dollar, it seems, and that's unfortunate, but it's going to take several years, in my opinion, for a real credible alternative to emerge.
And that would be like the weaponization of the US dollar, as you point out in the book, where other countries are
Yeah,
diversifying.
that's really unfortunate. And we see that happening in other countries as well. In Canada, for example, it was well reported that one of the things that the Trudeau government did was to freeze the bank accounts of people who were protesting. That again, that encourages you to manage your money differently because you introduce this political risk,
Hmm.
which pushes people away from your currency.
Could that mean, I mean, I don't know what your views are on this, but couldn't that push folks into, more cryptocurrencies like Bitcoin, for example?
Yeah, it could. But I think that's probably the wrong way to go about this. The government can easily shut down crypto as well. If you look at what happened in China, the government shut down Bitcoin mining. Okay, so I know there are ways around that, but if you have the government against you, then it makes adoption of your currency much more difficult. There's a lot of people who would not be comfortable doing things that are illegal, and so cryptocurrencies, I think, can be easily shut down by the government if they wanted to. There are people who don't think so, but um, my observation is that it can easily be done. So
Hmm.
it's not as good an alternative to the government currencies as some people portray, I think.
Yeah. Well, going back to the US dollar, and you point out that it could be several years where eventually it will lose its global reserve status. Do you think that will happen in our lifetime? I'm a millennial, and I take it you're probably, I think you're millennial
Yeah.
as
I'm
well.
one of the older
Well,
millennials,
I'm
yes.
technically an older millennial according to Bank of America, so we're in the same cohort. Do you think that would happen in our lifetime? And what are some of the implications? Like, how do you think about that scenario?
I think it will happen in our lifetime. I think it could. I'm not saying it's going to happen next year or even 5 years. I could see that happening in 10 years, in 20 years. I think it has tremendous implications because one of the reasons that so the US government has tremendous amounts of deficits. So it spends more than it receives every year, and it does so at an increasing rate. One of the reasons it can do that is because it's a reserve currency. It's a tremendous privilege. Now let's go back to 2020 during COVID. During COVID, people were suffering, and governments throughout the world offered a lot of fiscal stimulus. What's not, but if you look at what each government did, you come away with a very stark conclusion. The poorer countries, those that are, let's say, developing countries or emerging market countries, they actually didn't offer very much stimulus. They couldn't, because if they started to engage in a lot of deficit spending, their currencies would plummet. There'd be tremendous amounts of inflation. So their governments weren't able to offer as much benefits as the West did. And among the wealthier countries, the US far and away was most generous in its fiscal stimulus. The US is able to do that because they are the reserve currency. They could issue a whole bunch of treasuries to spend, and people would still hold those treasuries. It's a tremendous, tremendous privilege. If we move away from a reserve currency world where the dollar is not the reserve currency, there's not going to be that same amount of privilege. So that means the US is going to have to try to live within its means. It's not going to be able to engage in as much depth spending. Uh, that's I think that's going to be a really bumpy road because the US has gotten used to being able to use its privilege and just spend tremendous amounts of money whenever it wants with no consequence. I think what will happen from a day-to-day perspective for the everyday person is that interest rates will go higher and inflation is going to be a lot higher than we were used to.
Whoa. So like expect more inflation in the future.
Yeah, I think from my perspective, it's almost inevitable that we would have a decade, at least a decade of persistently high inflation. I'm thinking about 5%. It's almost, I think these are trends that are very difficult to fight against.
Yeah. Yeah. And like, would we take austerity measures or look at our own budget, kind of like how you would manage like a household budget when you get in this kind of situation where you have to like really tighten the belt, if we would actually be able to do that?
Yeah, that's a so one of the big drivers of inflation, in my view, is just the culture and politics of the era. Now, if we have a culture where, everyone is willing to tighten their belts, cut spending, I think we get back on track to lower inflation, let's say 2, 3% world. But that's just not where the culture is at the moment. Um, so I'll let's rewind back to the 1970s and 80s when we had serious inflation, sometimes as high as over 10%. Now, the Fed chair at that time, his name was Arthur Burns, and we remember him today as the guy who let inflation get out of control. Now, after he stepped down from Fed chair, he wrote a speech called The Anguish of Central Banking, where he kind of basically tries to defend himself for doing such a poor job. And his defense of himself, I found to be very enlightening. And what he was saying back then is that so at any time, I could have hiked rates and I could have got inflation under control at the cost of a very large recession. But every time I tried to raise rates to get inflation under control, I'd get so much pushback from the politicians and from the public about what I was doing. At that time, it was a time of a great social change. There's a lot of social programs coming online. There's a lot of benefits that people were having, and people really wanted the government to step in and improve the lives of the public by spending more money. And he didn't feel like the Fed at that time had the mandate to push against this because the moment that he hiked rates, everyone in the legislature was complaining that this guy is causing higher unemployment and all the people were upset as well. So he didn't feel like he had the political backing to do that. That was the culture at the time. They valued uh, low unemployment more than inflation, and they wanted basically everyone to have more money. That's kind of where we are today as a culture, I think. When I see what people talk about on Capitol Hill, it seems like they want to give more benefits to people. And of course, it's well-intentioned. They want people to have better lives, but they're not talking about the consequences of that, which is more inflation. And it wasn't until they had a decade of high inflation in the 70s that the public was truly fed up with it. And there was enough political backing to say, yes, let's tighten our belts. We're going to take a little bit of pain, but we want to get inflation under control. But it took 10 years for the country to get there. And right now, we are just, I think, pretty early in our inflationary cycle. So eventually, I would expect that people would get tired of high inflation and they would be willing and able to do the more difficult choices to be able to get back to 2 or 3% inflation. But I don't think we're there yet.
Wow. Well, cover a lot of macro on this show, and it seems to me that inflation is like the most important stories as it relates to macro. And usually when I kick off the show, I kind of start and ask the guest for their big picture, their macro view. And I didn't do that this time, but I was hoping as we were talking about inflation, you pointed out that you think we're early in that cycle. I'd love to hear your macro view if you wouldn't mind just taking a few minutes to unpack it.
Yeah, so at a very high level, inflation is when demand pushes against supply, right? You have, let's say that you have 100 people who want to buy a car, but you only have 90 cars available. So that means there's going to be some bidding, prices are going to go higher. Now, the big picture that I'm looking at is that we have a world where demand is going to continue to grow, but supply is not. Demand is going to continue to grow because the government is going to continue to spend a lot of money, and the government has made many promises to our retirees and to uh, you know contracts and military spending and so forth to continue to spend money. But what's changing now that we haven't seen in, I don't know, a few hundred years is that our population, our working age population, isn't growing. So in order to have growth, you can have one of two things. One is if you can have more inputs. So if you have more people working, then obviously you can produce more stuff. So you have more economic growth. Another way is to have productivity growth, so technology. So you have the same inputs, but because you have better technology, you can produce more stuff. Now, technology is always something that's difficult to model. Sometimes someone somewhere has a brilliant uh, idea and they fundamentally change the world. But it's really, that's kind of random. You don't really know when that will happen. But what's much more easier to think about is just basic inputs. Now, for all of history, the human countries have been steadily growing, right? We have a population today is a few billion, 1,000 years ago, a fraction of that. But something changed a few decades ago, and that is people have smaller families now. Just not too long ago, maybe 2 generations ago, people would have families with 6, 7, 8 kids. But now they have very small families. And the implication for that is that the workforce population is not growing anymore. We have fewer workers. If we have fewer workers, it's impossible to have the same level of economic growth simply because there's not as many people working. Now, this condition is different across the world. In the US, it's somewhat stable, but in Europe, it's declining significantly. In China, it's declining even more. So if you have a world where there continues to be spending and demand from the government spending and from all the boomers who are spending their savings, but the supply of goods and services is not the same since there are fewer people working, then obviously you're going to have higher inflation. Now, another way to think about this is, let's say right now, today, half the people in America are retired. Okay. If half the people in America are retired, the next day, they're going to still be spending their savings. They're still going to be going to restaurants and buying stuff because they have savings that they saved up for their retirement or they get money from the government. But then if half the people retired, who's going to do the work? Who's going to be the waiter? Who's going to be the chef? Who's going to work in the factories? You're going to have to, you're not going to have as much supply. So all the prices are going to go higher to equalize that. I think that's the big picture for the next 10 years, actually. So it's not always going to be like that. Eventually populations will equalize when I guess the boomer generation passes away, but we're many years from that, I think.
I know you mentioned like the technology side is difficult to model, but have you thought about the implications of large language models, chat GPT, the impact on work, jobs, productivity?
Yeah. So we do have big advances in AI like ChatGPT. And you know what? I imagine one day we'll have a world where robots will do all the work and we'll have robots that make robots. So basically we'll have infinite amounts of resources because robots would do everything. But that's I don't know when that is. And it's really hard for me to be able to have a grasp on just how fast technology advances in that sense. So I can only go with the things that I think are more reliable. That is demographics that can't change, and you want to have a new person, you need another 20 years. But it could be that we have huge advances in robotics and AI and technology that really, really increases the amount of supply of goods and services in the economy, and that would be hugely deflationary. But that is at best speculation.
Yeah, probably still too early too. I just wanted to hear your thoughts if you had any on that. I would love to bring up with you the recent banking crisis, banking panic that we had. I know you have commented and written about it and talked about it. Are we past it now? Is it over?
Yeah, I definitely think it's over. And so remember that in the beginning of our conversation, I noted there are some things that you learn if you are from a central bank and that people outside don't understand as well. And banking is one of those topics, because if you're at a central bank, you have access to a lot of regulatory filings from commercial banks, and you speak with them regularly, so you have a sense on how the system works. So in my view, the banking panic was never going to be a big crisis. It was always going to be something very minor. As people, we often think that the future looks like the past, and many of us lived through the failure of Lehman, and so we have a lot of, I guess, traumatic memories of that. And so when we see a bank go down, I think people panic a little bit. But that was never going to be the case for a couple reasons. One is that the state of the financial system is much, much more liquid compared to pre-Great Financial Crises. As an example, pre-GFC, the entire banking system had about $50 billion of cash on deposit at the Fed. Fast forward to today, they have about 3 trillion. So when you have $3 trillion of cash at the Fed, it's really hard to have liquidity crises. The second thing I think people don't really grasp is that there have been so many changes in regulation today compared to pre-GFC, such that banks are actually really boring businesses. They're almost socialized. So it's really hard for them to go bust, to really take down the system at least. So we have a banking system with about 4,000 banks in the US. Some of them are going to be poorly run businesses, so some of them are going to fail. If you take a step back and you look at what happened, the banks that failed, Silicon Valley Bank, Signature Bank, these are banks that had very close ties to speculative tech like crypto. And so when speculative tech like crypto went bust, I don't think it's surprising that it hurt them as well. But upon deeper inspection, they were also very poorly run. So it seemed to me always to be more of a localized problem. And the data points that I look at today tell me that the problem is over. So I look at a few things. One, for example, is that how much emergency lending is the Fed doing to the commercial banks, right? The Fed is the lender of last resort to commercial banks. During the crises or during the panic, we had Fed lending to commercial banks rise significantly. That's plateauing and slowly dropping off. Another lender to commercial banks are the prime money market funds. We had a lot of outflows in March when investors were panicking. Now we have inflows. That tells me that people are getting more comfortable with lending to banks. I think what people care about when they think about banking now going forward is how big of an impact will that have on the economy? Since, as we noted in the beginning of our discussion, banks create money. So when the banking system is healthy and functioning, people who have worthy projects are getting money, they're able to get funded, and the economy grows. And on that note, the two data points that I've been looking at seem to show that things are getting better. Last week, the Fed aggregate data showed that commercial banks are making loans again. So loan growth is resuming. It stopped for a bit, but it's resuming again. So again, the banking system is healing. And the second point, which is, I think, more important, is what the banks themselves say. Now, the big banks, the G-SIBs, JPM, Citi, Wells Fargo, JPM said they didn't see any decline in consumer spending throughout the quarter. Citi noted some decline, and Wells Fargo is like, yeah, some slowing, but we're still growing. So everyone, all the big banks, which have huge networks, are a huge chunk of the banking sector, have a lot of information, are telling you that things are okay. This week, we had some regional banks report. M&T beat expectations. Charles Schwab also had suggested that things were basically as expected and things were not terrible. So that again gives me confidence that this banking panic is truly over. And what it really was, in my view, was a tremendous overreaction.
What do you think? And maybe it's not even worth like thinking about at this point, but do you think that the intervention was the right move, or do you think what do you think would have happened if there wasn't any intervention? They didn't back up the depositors that were above that 250,000 FDIC insured level?
That was a really tough policy call, I think. So let's rewind a bit. So during the great financial crises, the big banks, they made huge speculative investments, huge bonuses, and then at the end of the day, when they went bust, the public had to go in and clean it up. So the public, understandably, felt that was very, very unfair. So they said that Congress, through their elected representatives, said that we never want this to happen again. So we don't want to have too big to fail. And if you're looking at other countries, like Eurozone countries, they said that we're going to have bail-ins where the investors in the banks, even including the depositors, would take some haircut in case the bank got into trouble. I think what we learned now is that that's just not realistic. When you have a bank panic, the government is going to go in, step in, and they're going to save all the depositors because the government is really afraid of contagion. And perhaps because in the age of social media, panics can spread easily, where what would have been just a local bank run in Silicon Valley could have become more widespread because there are people on the internet, shouting fire all the time. I think that is kind of a reality that policymakers are going to have to accept, in that in the age of social media, contagion is very possible and can be very quick. So anything short of a full deposit guarantee could be very negative. Ideally, I think that banks who are poorly run, they should be, you should just let them fail. And the depositors, you should have done due diligence. But I think in practice, that's not practical. So in the future, I think this playbook of guaranteeing all depositors is going to be the playbook that all regulators use going forward. In fact, it was also used in Switzerland, right, with Credit Suisse, and that was also a surprise, since they do have a rule book where I think depositors would take haircuts, but they were afraid to use it.
Yeah, I think, and the debt wiped out in that case, or
Yeah, there was an interesting case there. So, okay, so usually if a company goes bankrupt, so it doesn't all go to zero. So if you're a creditor, you get something, but there's an order of priority. In that order of priority, the lowest people, the people who usually get wiped out because they're the lowest in the payments waterfall, are the equity holders. Above that a little bit are the preferred shares, and then unsecured debt, subordinate debt, and so forth. What was unusual in the Credit Suisse situation is that the common equity holders got a little bit of money, but I think it was the preferred holders or someone, the COCO, the convertible holders, they got nothing, and that was surprising to the markets because it seemed to violate the sense of rule of law, where someone who was perceived to be a lower priority got a little bit of money, whereas someone who was perceived to be a higher priority got nothing. Now, the Swiss regulators, I think, pointed to some vague language in the issuance documents saying that they could do this or something like that. But it's possible there might have been some political concerns as well. As we know now, I think some of the Middle Eastern countries were major investors in Credit Suisse, and I imagine they would be very upset to be completely wiped out. So maybe they gave them a little bit of cash. They're holders of the common equity. So that was very surprising to the market, I think, and I think there many people are fighting that. I don't know how that will turn out.
yeah. And I guess going back here in the U.S., if it's this notion that the playbook going forward will be to back up all depositors, I guess that kind of just makes banks theoretically safe for no matter what, I suppose, for a deposit.
Yeah, I think that makes banks a lot safer. So the reason that people don't like to, so the concern here, of course, is something called moral hazard, whereas now that now that maybe you encourage the banks to do riskier investments, and if riskier investments turn out well, they'll get a lot of money. And if they go bust, well, at the end of the day, the government will come in and bail out all the depositors. So that's the risk there. But I think going forward, I think the assumption, in my view, would be that all depositors are insured simply because the government has shown that they are afraid of bank runs.
Mm-hmm. And I know we only have a few more minutes, but I just want to kind of go back to something that came up in this conversation was this disconnect between what the Fed officials have been saying around interest rate outlook and the disconnect between like what the market's saying. We were talking about this kind of notion like the market's kind of fighting the Fed. Um, can you just help me understand a little bit more? Because how does that tie into like your views of the economy and how it plays out? The Fed is going to, it sounds to me like they're going to stay tighter for longer.
So the Fed is in inflation fighting mode, and what they're looking at is they're looking at something they think of as uh, a core measure of inflation. So inflation overall has been trending lower, but if you look at more sticky aspects of inflation, so what the Fed will think of as supercore, which is largely determined by wages, it's not coming down a lot. And so the Fed is telling everyone that I'm focused on wage growth and this supercore measure of inflation, and it's not budging. So I'm going to stay higher for longer. I want to keep interest rates around 5%. The market has been aggressively pricing in rate cuts towards the end of 2023, and the Fed is not really sure why. So some Fed officials think that it's because the market thinks that inflation is going to come down faster than the Fed expects, and so because inflation comes down faster, the Fed will cut rates. Other Fed officials think that the market thinks that the Fed is concerned about financial stability, given what happened with Silicon Valley Bank, and so they're going to relent and, for the sake of financial stability, try to cut rates later in the year. So anyway, so we look at market pricing, but we don't actually, we tell stories to explain that, but no one knows for sure. And people buy and sell for different reasons. So there could be truth in both stories. But the Fed is looking at this and it's pushing back against both stories. One, the Fed thinks that inflation is going to be more persistent. And two, the Fed thinks that if there is financial stability concerns, we do that through regulation rather than interest rate cuts. I think that what will happen is going forward in the next few months, as data continues to be okay, and as the banking panic subsides and more people understand that there really was not a serious banking panic, then I think the market is probably going to go and converge towards the Fed's path. And that has tremendous implications for all market asset prices. This past month, it's really been one big trade. So the market is betting on Fed cuts later in the year. So you see the dollar sell off, you see gold go up, you see equities go up, and you see treasury yields go down. That's the one big trade. And as that reverses, all those other asset prices will reverse in direction as well, in my view.
Yeah. Because I noticed, yeah, the gold's come down from, it had just been on a tear. It's
Yeah.
come down from where it had been in recent days. Got it.
Yeah, part of it is because of the weaker dollar, because the market prices in Fed cuts. So if the market doesn't price in as many cuts, then dollar could strengthen again and gold could go down a bit.
Mm-hmm. Well, Joseph, I have to say, I have really enjoyed having you on and getting to listen to you and learn from you. It's been an absolute delight. And I was hoping I could just give you the last couple of minutes for any parting thoughts, anything that we did not bring up in this discussion that has been top of mind for you of late. And if you want to let folks know where they can pick up your book, read your blog, follow you on social media, find out more about the work that you've been putting out there.
Yeah, so I think we had a really good discussion. Thanks for having me on. I enjoyed discussing how I view the markets and macro right now. If you're interested in learning more about my work, I have a website, fedguy.com, where I write and blog about the markets. There's my book, Central Banking 101. And if you're interested in learning more about the markets, I also have online courses where I teach about how the financial markets work. These can all be found on my website, fedguy.com.
Awesome. Well, Joseph Wang, I've really enjoyed having you on. Thank you so much for being so generous with your time and your ideas, and would love to have you back on in the future. Thanks again.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.